The latest Conference Board of Canada provincial outlook has good news for Ontario. Our economy is expected to grow by 2.9% this year, a full percentage point above the national economic outlook. Joining us now for more on the report, here's Pedro Antunes. He is Deputy Chief Economist with the Conference Board of Canada. And Pedro, it's good to have you here at TVO.
It's a pleasure, Steve.
Let us share with our viewers what you already know. Sheldon, if you would, let's bring this graphic up, province by province. Here's the way it looks. Over 2015, we know what's happening to commodity prices. So Alberta, we see negative growth, Newfoundland and Labrador, Saskatchewan, slower growth than in years past. But as you go on towards the right of that chart, there's Ontario, almost at the top of the chart, up there with Manitoba and British Columbia, for strong economic growth, relatively speaking, forecast for this year. Let's get into this. Why such a bullish outlook?
Well, we've been waiting a long time to see Ontario at least get to a pace in line with the national average, which is, the province has been facing some difficult times for a decade now. And we've been really waiting on two things. One is a stronger U.S. economy. You know, there was a restructuring in the manufacturing sector through the early 2000s. That was the early problem. And since the recession, we've been waiting for Ontario's main trade partner, the U.S. economy, to do better. And that's finally coming around. We had a glitch in the first quarter of last year, but since then the U.S. economy has been building more and more momentum.
So overwhelmingly that 2.9%, we can thank the Americans for that.
We can thank the trade sector for sure. The Americans and American demand, which is, it's in fact global demand. If you look at the U.S. consumer, it's 15% of the global economy, and it's really important in terms of Ontario's trade sector. Doesn't
hurt as well, I guess, that our buck is not trading at $1.03 American anymore?
Well, that's the other very important piece. So all of a sudden, we're seeing the U.S. really firing on all cylinders. We're seeing an exchange rate that is going to be very favorable in terms of at least on a competitiveness and cost basis. We're going to see our manufacturing sector and our traditional industries kind of revived into that traditional market. So there's some good news there. There's some challenges as well that we're a little concerned about.
Well, let's follow up on that, because 2.9% presumably doesn't mean across all sectors, right? Who's in trouble?
Absolutely. So we are looking at manufacturing to do better in general. The auto sector rebounded over the last couple of years. In 2010 and 2011, in fact, it was where we saw the biggest gains there. That market isn't growing as strongly, and the real problem for us and the concern that we have is, can we ride the coattails of the U.S. economy if we really haven't invested enough in retooling and in building capacity in those sectors? So this is the little challenge that we're waiting to see. It's been very disappointing in terms of the investment over the past couple of years. If we look at 2014, investment in retooling was actually negative across Canada and in the province. So we need to see that pick up a little bit.
Why hasn't it?
I think it's an issue around confidence. For a long time now, we've seen essentially the business sector in Canada and in the U.S. really battered by that financial crisis. So it wasn't just a recession in 2008, 2009. It was a recession, financial crisis, and we know that these kind of crises, financial crises, tend to have a much longer term impact on the psyche, I think. And if you look at we've heard this often from south of the border and here in Canada about how much cash in reserve that a lot of corporations are holding. So there's that ability. The money's there.
They're sitting on dead money, as
they're sitting on that money.
Former governor of the bank called it.
Exactly. It's a prudence issue among investors.
So if auto is not doing well, we know out west, of course, commodities in big trouble. Which of our sectors in Ontario are performing well?
Well, Ontario in general, again, if we're talking about the trade sector, outside of the auto manufacturing sector, there's a lot of potential there. And again, we service manufacturing and we service, the machinery and equipment investment in the U.S. That's growing very strongly. We service the consumer. We service, when we look at aerospace and other diversified manufacturing, I think this is where we're going to see some gains. But the other piece that's important is, an oil price shock puts a lot of cash flow or a lot of cash back in the pockets of consumers. So this is the other piece that we're seeing helping to boost up the Canadian economy.
Let me follow up on that, because the way it's been described to me is that people in Ontario this past year got an unanticipated $500 to $1,000 tax cut because gas is so cheap these days.
Exactly.
What kind of an impact does that have on consumer confidence, the ability to spend, the ability to prime the economy, and so on?
Well, we actually track consumer confidence, so it has been trending up over the past year in Ontario. We've had a little downgrade in confidence in the latest month, but that doesn't preclude the fact that, yes, you're absolutely right. That's a lot of what we call disposable income, I guess, back in the pockets of consumers. We should see some spending from that, and that's going to happen across Canada. That will, because Ontario is diversified, it tends to keep that income here a little more than in other places.
As a conference board economist, if somebody got, let's say, a $1,000 tax cut in effect because the price of gas dropped so much, is it your preference, because it's better for the economy, that they go out and spend that on consumer goods, or would you rather have them cut down their debt or bank it, or what's best?
Well, that's a great question. I mean, again, when you talk about economic outcomes, there's always a cost versus a benefit. There's always and in this case, it's kind of near-term benefit versus long-term cost, or vice versa. So if Ontarians were to save that, likely we'd see better outcomes in the very long term. But of course, the way we measure GDP, economic activity, if they spend it, of course, that has a quicker impact and a direct impact on the economy today. Now, when we think about households and we think about debt levels, et cetera, there's a lot of concern about household debt levels as a share of their income.
Getting too high.
Getting high, but we're not too concerned about that, in the sense that what we're seeing is essentially a trend that's been going on for 30, if not 50 years. We have seen debt levels rise in general across Canada. There are assets to back up that debt, and we are building equity in our homes with very, very low interest rates. And the other piece is, when you look at the cost of financing, the interest cost of financing all that debt, they have never been lower.
Right.
So they're at 6% of income, down from 10 and 12% what we've seen in the past. So very, very low.
Is it the case in Canada, I hearken back to that original chart that we saw with the oil-producing provinces doing so poorly, Ontario, British Columbia doing better. Is it a zero-sum game? In other words, we only do better when they do worse.
Well, I think that's a wrong impression that people have. Certainly, when we look at the currency is tied to commodity prices in general, and of course, oil plays a big part of that. So, in terms of currency movements, yes, there is some tie-in. But if we go back to Ontario's, what has ailed central Canada and Ontario in the past decade, we're talking about a restructuring that happened in manufacturing that was going to happen anyways, with a dollar at 80 cents or with a dollar at parity. We cannot compete in labor-intensive manufacturing. It's just not, it's just not where we can compete with the rest of the world, with the developing world and the Chinas. We need to think about where we can compete, and that is, the knowledge economy. Even in manufacturing, we can compete, but it's capital intensive, and the people working there are programmers, they're robotics specialists, they're statisticians looking at what's coming off the line. These are the types of jobs. And then the other piece, of course, is on the service side. We've seen a lot of very good jobs in other professional, scientific, service sector employment.
Let me ask you more about jobs, because you would have the numbers, but it's certainly conventional wisdom that a lot of people left the province of Ontario to go out west to work in what was at the time just a booming oil and gas business. Now that they are retrenching, do those workers come back to the province of Ontario and in effect contribute to what could be a higher unemployment rate here, because we may not have jobs for them here?
Well, that's a good question. Certainly we have seen a very dramatic change in net migration into the province. Ontario used to attract net interprovincial migrants. It's always attracted international migrants. But in the last decade, Ontario has been losing out. You're absolutely right. People have been going to other areas and mostly pulled to the west and Alberta. So that may change, but I think it's for the better, in the sense that it's a bit of a rebalancing. Alberta has been a very hot economy. Wage increases in that province have been phenomenal, and they have been having trouble controlling costs, et cetera. For Ontario, I don't think people will necessarily flow back unless there are jobs available. So we are expecting a stronger economy, we're expecting better job gains, and we are actually expecting the unemployment rate to decline over the next couple of years with that strength.
We know the Ontario government would love the economy to be firing on all cylinders and create tax revenues that can lower their deficit, and I want to read something that Martin Redcon of the Toronto Star had in the newspaper just the other day. By one account, Ontario's economy is bouncing back this year and destined to outpace the country through 2016. Exports are surging, the economy is growing, unemployment is dropping. But by another analysis, the province risks blowing the budget between now and 2017-18. The debt has topped $300 billion. Tax revenues are down $500 million. The deficit is still stubbornly high at $12.5 billion. The only certainty is that Ontario's finances are utterly unpredictable and laughable. The latest report from the usually humorless Moody's credit rating agency almost lampoons Ontario's budgetary outlook. Moody's mockery? It compares historically rock-solid Ontario to traditionally quaky Quebec and concludes that the budgetary reliability of Queen's Park is falling behind its once shakier neighbour. That's the Queen's Park columnist for the Toronto Star saying that. How significantly could this expected improvement in our gross domestic product help the government deal with that outsized deficit?
Well, it's a tough situation, and when you look at the deficit, and in fact, when you look at the government's plan to address the deficit, it's really a plan around expenditure restraint. And our sense is, yes, we are going to see revenues grow a little more strongly over the next couple of years. You mentioned earlier 2 years of very strong growth. We agree. But then in the longer term, Ontario kind of falls back to a normal pace of growth.
Which is?
Which is, alongside the rest of the economy, around 2%. So even if we see 2.5%, 3% over 2015, 2016, this is we're going to be back where the normal revenue growth is around 4.5% perhaps for the province. That's in nominal terms. Now, when you look at the spending plan for the government, currently it really is to hold program spending very, very tight. Healthcare at only 3%. I think overall spending at about 1%. If you look at the
a lot of ministry is going to be cut big.
It's going to be very challenging, and the biggest piece around that, of course, is healthcare. So we've seen it in the past. You can hold healthcare spending for a few years to below the kind of ordinary or fundamental demand for healthcare. But if you try to do that for too long, then all of a sudden, you're catching up and you're spending even more. So, this is, I think, the biggest challenge for the government is, will they be able to really hold healthcare spending at their targeted 3% for such an extended period of time? I mean, we're hopeful that it's possible.
Well, they have for a couple of years.
They have for a couple of years. We're hopeful that it's possible if you can change the delivery system and make it more efficient and be able to deliver healthcare. But if you look at the demographics and you keep the same healthcare system that you have today, it's just the costs are going to explode.
Let me get back to oil. If, I don't know, what's West Texas Intermediate trading around $50 a little,
Just 50 was what I saw the other day.
50, yeah. So if that starts to nudge its way back up, which obviously Alberta hopes, 60, 75, 80, maybe back towards $100 I don't know if anybody's forecasting $100 a barrel over the next year. But if that happens, does the Ontario economy then start to go down as a result?
Well, this goes back to that challenge around the petro currency, and yes, I think we do have a currency that is tied to commodity prices and the oil price. So we do expect oil prices to have settled. We do expect oil prices to come up slowly. It's going to be a different world. It's not going to be $100 or $95 oil anymore. It'll be less so. But that still suggests that we'll see some upward pressure on the currency. And that will challenge the competitiveness in some manufacturing segments. But what we have to think about is, first of all, we need to forget about manufacturing as labor intensive. So it's capital intensive manufacturing that we can compete in. And the capital, in fact, comes from outside of Canada. So we need to take advantage of a strong or fairly strong currency to be able to beef up our retooling, to be able to make manufacturing competitive in the rest of the world, and not think about the labor component, which is associated with that rising or appreciating currency.
I got 30 seconds left, Pedro, to ask you about the credit rating. Obviously, Ontario wants to keep its credit rating as low as possible so that the cost of borrowing stays as low as possible. Moody's, one of the credit rating agencies the other day, said we're not raising the credit rate, or we're not lowering rather the credit rating, but we are looking with deep concern at the size of the deficit and debt. Where do you think things are at on that front?
Well, I think, first of all, if we look at, we talked about the situation for households, it's very similar for government. So when we look at the rise in debt and the payments on that debt in terms of the interest cost of that debt, they've been very managed still. But I think there is concern. If we're hearing that we may see rate hikes in 2016, we should see them south of the border perhaps earlier. So I think there's a lot of concern about, as rate hikes start to come in, will we see the government be able to manage that in a way that's according to plan, I guess.
Gotcha.
Yeah.
That's Pedro Antunes. He is with the Conference Board of Canada, and we're very happy you made some time for us at TVO tonight.
It's a pleasure.
Support Ontario's public television. Donate at tvo.org.